Welcome back. You're watching The Money Show with me, Kavita Thaplial, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Kaustuv Belapurkar, Director, Fund Research, Morningstar Investment Advisors, India. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your queries on themoneyshow@etnow.tv. Kaustuv, good evening and welcome to the show. We have a lot of viewer queries for you. Also, viewers who are watching us live can also send us their questions on our WhatsApp number, which was just flashed on the screen. But let's begin, Kaustuv. And we have Vishwas Kulkarni's question for you. And he says that he's been investing in... he wants to know how is ICICI Pru and S&P BSE Index Fund, and he is looking to invest almost 12,000 per month for the purpose of his retirement. We don't have him on the phone line, otherwise we could have taken more details, but then whatever we have, what do you suggest?
Sure. Hi, Kavita, and thanks for having me. So I think, obviously, like you said, the details are slightly limited in what Vishwas has shared with us, but let me just share some thoughts about firstly, obviously, it's great to know that he's investing in, equities through an index fund. He's doing it, through an SIP route, 12,000 rupees per month. So he started his investing journey, which is great. Now, to my mind, and, there's this whole active versus passive debate going on. And I think, there's place in every investor's portfolios for different strategies. And it's not an active versus passive, it's an active and passive together can coexist in portfolios, right? And so that's kind of the first point I want to make. That said, I think passive is a great, kind of a no-brainer, low-cost investing tool for any investor who wants to invest in the markets. But it's like, you started saying, how do you pick the right fund, right? Often gets very, very confusing for an investor that, which is the right kind of fund for me. So just buying a passive fund that mirrors a broad index like, one of the highlight indexes like the BSE Sensex or the Nifty 50 or some of the broader indices that we have available in the market, you can at least get equity participation rather than waiting on the sidelines, trying to pick funds or, as we've seen a lot of investors do, chasing performance in funds that have recently done well and then dumping them as they start going through periods of underperformance. So I think that's the moot point, that if you don't have the wherewithal to do it yourself, either consult an investment advisor who can help you do that, or pick index funds, at least start the journey in terms of investing, right? Now, obviously here, Vishwas has mentioned that he wants this as a retirement fund. So I'm assuming that his retirement is at least 10 to 15 years away. That's an assumption that I'm making, obviously, based on the information we have. But if that is the case, and, the other important thing that, we need to articulate is risk-taking. There are two dimensions to risk-taking, which is the ability and the willingness, right? So ability stems from the fact of, what is the financial situation of the investor? What is the investment time frame they're looking at? That decides the ability, or the risk-taking ability that an investor may or may not have. Second is the willingness, which is, the mental makeup of an investor, where are they willing to take risk to earn higher returns or not? Now, we all know equities is a great asset class. Now, the fund that Vishwas has mentioned is largely, the top 30 companies in the index, so it's a large cap fund, so to speak. If he has that 10, 15-year horizon, as we mentioned, his ability to take risk is actually higher than the average investor in the street, right? Because, he has a long-term horizon. So while large cap is great, he can actually look to allocate certain portion of his portfolio. When I say certain, it will be maybe in the range of 20 to 30% to small and mid-cap funds, where he can take the actively managed route, and there are enough and more good small and mid-cap funds that are available, I would say in a 2010 sort of allocation. He can allocate to exposure to in his portfolio to that through the SIP route. And, that's where I would kind of leave my, suggestions to Vishwas for his portfolio.
All right, but then what about the investment amount, and what about lining up that particular goal in terms of strategies? You've advised him in terms of fund selection, but then what will go into the calculation that's needed to come down to the corpus that you need for purpose of retirement?
Yeah. Sure. That's, I think that's very fundamentally, very, very good question, Kavita, because, more often than not, we tend to forget the bigger picture, why we're investing, right? So I think the math every investor needs to think about is first is what is the money that I'm setting aside for? What is the purpose of this money, right? So like in Vishwas's case, it is retirement. And then the next question is, what is the time horizon that I can keep this money aside to kind of grow for me, right? So like the assumption that we made, maybe 10 to 15 years, that's a reasonably, good time frame to invest. Depending on that, and obviously, every investor's financial situation as to how much can they save and put aside every month from their monthly paycheck. Uh, we kind of decide on what an asset allocation should look like. And typically, the longer term, the more longer the asset allocation, you would tend to build allocations which are more equity heavy, which can pay off over the long term, but can be volatile in the short term, as we all know. And a little bit of fixed income, it could be in terms of diversification and emergency fund and things like that, right? So I think that's the first kind of math that every investor needs to do. The second thing, and which is often not that well acknowledged, is as you approach your goal, you need to change your asset allocation. So the asset allocation when you started your investing journey maybe 15 years ago might have demanded that you are largely an equity investor. But as you approach a goal, and it's a very important goal for you, it could be your kids' education, marriage, or your retirement, you do not want a large impact market movement on your corpus, right? So that's why it necessitates that, as you're approaching your goal, and that doesn't mean just a few months out, a few years before you start approaching your goal, you should systematically start reducing the volatile exposure, which is typically equity exposure, into more consistent sort of return asset classes such as fixed income. Obviously, the returns will be lower, but more predictable, right? And that's very important because then you can get a reasonable corpus that's built in. So all of this needs to be built into your calculations when you put that. And each of us can do that into an Excel sheet. At least get a ballpark figure of what is the money I need to put aside every month to get to a corpus that I think I'm comfortable, for a goal like retirement.
Got it. Very well explained, and I hope Vishwas acts accordingly and make the necessary changes. But then we have a viewer online, Kiran from Solapur. Hi, Kiran. Good evening. Thank you so much for sending us your query.
Hi, Kavita. Thank you for considering my query. I wish to invest 10,000 rupees per month. I had recently started mutual fund investment, and I'm investing in a large cap category. Canada Robeco Blue Chip Equity Fund, Direct Plan Growth.
Okay.
That is what I have selected. So my question was, is this the fund selection from me correct? The supplementary is like, in your opinion, what would be the best fund in this particular large cap category to start an investment? Yeah. My investment horizon is at least 10 years and more than that. Yeah.
All right, that's a good time horizon. But then also, you just want to put 10,000 in a large cap fund, or you want us to help you with creating a investment strategy for 10,000, which can be more than one fund. Are you okay with that?
10,000 in large cap. So probably as I try to understand this particular mutual funds, probably I will start with the newer investment in probably some different debt schemes or balanced schemes as well, in order to have a balanced portfolio. Yeah.
All right.
But 10,000 is particularly only for the large cap.
All right, 10,000 only for a large cap category. That's very interesting, Kaustubh, because he's one of those investors who really want to participate in this particular category in an active way. But what will be the right solution for him right now?
Sure. And I'd like to break that conversation into two bits, sort of two parts, Kavita. And I think that's a very valid sort of conversation that Kiran brought to the table, that this is the first time that he's kind of looking to invest into mutual funds and wants to start. And I don't see any harm starting with purely a large cap exposure to get a sense of how mutual fund investing works, and that's probably a good way to start. But I'll just take that conversation back to my earlier response. And this is something which obviously Kiran doesn't need to think about right away. But as he rightly said, that once he takes his exposure, feels more comfortable investing in the markets, can probably look at other categories of funds. So we spoke about the ability or the willingness. So right now, when I think about Kiran's ability to invest, because it's a 10-year investment horizon, and as long as Kiran is very clear that this money is something that he is not going to touch for at least 10 years. So he's going to let the money grow, continue to add through a monthly SIP route to this corpus, month on month, and in fact, step up SIPs. That's the other thing that we talk about later. But if he can do that, and if that is very clear, then I would definitely think that it makes merit or a case to while large cap exposures are great and it should definitely be a sizable exposure in any investor's portfolio, he can also down the line start thinking about that. Perhaps he can take or dabble a little bit of mid and small cap exposure within his fund, given the factor that he's got at least a 10-year investing horizon, because those can, obviously add, sort of alpha over even large cap funds, as long as the investing horizon, which in this case is at least 10 years, over a period of time. Mind you, there can be volatility, much sharper drawdowns, which, the investor should be ready for in mid and small caps, like we've seen in the past. But, there's no harm thinking about taking a graded exposure, maybe 20%, as the overall portfolio, constructive ones. Now, specifically about the large cap exposure that, Kiran alluded to. So I think obviously the fund that he's picked, it's a good fund, the Canada Blue Chip Equity, and obviously Sri Datta has been managing this fund, for a fairly long period of time. And the good part about the strategy, that we like, that it's been managed with a consistent approach and style, right, which is more kind of growth-oriented quality companies, so compounders of, growth, where, what Sri Datta is kind of looking to pick. The only thing that I want to bring about here is because it's a single exposure or a single this thing that he's looking to take. Remember, as we've seen in the past, there are cycles in the market. And there's a different cycle that's playing out right now. So we spoke about growth investing, which worked very well in in the years of 18, 19, 20. Value investing, where managers look to buy intrinsically cheap companies. So they might not be growing at a very fast pace, but intrinsically they're undervalued as compared to what the value of the stock should be. Now, that was not really paying rich dividends in the years 18, 19, 20, when growth investing was working well. And obviously, this fund did exceedingly well during that period, given its growth style approach, right? Now that values to come to the fore, value managers, if you look at the large cap space, are doing relatively better than the growth managers, which is perfectly understandable. So I think my approach, to Kiran would be that, if you buy this fund, the fund is good. You need to be patient, even if the fund relatively goes through a period of underperformance versus its peer group in the near term, because we know that managers stick into its style, and as growth comes back, when the market cycle turns, the fund will continue to then kind of do well because it's stuck to its style. The other approach that you can take, if you want to stabilize the returns of your portfolio, you can actually add a fund that probably has a little more of what we call valuation bias. It could be a growth at a reasonable price, or a more value approach within their portfolio. Then what that will do or allow you to do is you will have a good mix of funds within your portfolio, not just purely growth oriented, but a mix of growth and value, which can give you a more consistent performance across market cycles. So then you look at it a portfolio construct rather than just a fund level approach.
All right. So on that note, Kiran, all the best for your investment portfolio. We have Sanoj Paul from Gujarat Online. Hi, good evening. How are you doing?
Hi, good evening, madam.
Thank you so much for sending us your query. And all right, so you want to know about which fund?
Actually, I have just started my investment in mutual fund through LIC SIP, which is I have given to them for the 10 years, and they have I've chosen the growth fund. So, what is the future of that LIC SIP?
This is your first investment?
Yes, first investment.
All right. Kaustubh, again, we don't have a lot of details.
Yeah, Saroj, do you know the exact name of the fund that you're investing into?
LIC.
The fund category details with us, but then because Sanoj is a first-time investor, what should be the fund category that he should begin with, and later on, maybe if it matches with the fund that he has in the portfolio, he has a takeaway for his question.
Yeah, so I think a couple of things. Again, I think what Sanoj should be thinking about is, it's great that he started, and I'm assuming this is the LIC mutual fund investment that he started through, and because he mentioned SIP route. The first thing that again Sanood needs to think about, and just some pointers or kind of ground rules when you think about constructing a portfolio. Firstly, just think about what is your time horizon that you can keep this money aside for, right? So, and I think he mentioned 10 years, which is great. Then again, I would go back to the drawing board and say that if this is money that you don't need for the next 10 years and you're going to continue to add month on month, you can potentially start with large cap exposure, right? So if it's a large cap or a flexi cap exposure, which probably takes 20-30% exposure mid and small caps within the same fund, right? I think that's the approach that I would look to take, and there are several well managed large and some of the names that come to mind from the large cap space is obviously the ICICI Blue Chip. There's the Mirror Large Cap. From the Flexi Cap space, your funds like Parag Parikh Flexi Cap or Kotak Flexi Cap, which are excellent funds to start the investing journey with, where you can start an SIP. It gives you any reasonable sort of exposure, largely biased towards large caps, with a little bit of mid and small cap kicker, given that it's a 10-year investing horizon. Definitely continue down the SIP route. But I think the other important thing, which highlight is every year increase your SIP amount, because as your income goes up, it's important that your investment amounts also go up. 10% is like the floor. Ideally, you should be looking to ramp that up even faster, because the sooner you start, the larger purposes that you keep aside at the start of investing journey, the joys of compounding are going to be that much greater. So I think that's important to keep in mind when you're constructing a portfolio. Equities need to have a minimum 5 to 7 year investing horizon at the very least, which I know Sanood does, which is great. So just continue to buy into some of these funds that I mentioned, and I think should be a pretty good experience.
All right, all the best, Anuj. And we move on. We have Siddhartha from Bhubaneswar. Hi, good evening. How are you doing, Siddhartha?
Yeah, I'm good. How are you?
Okay, so are you a first-time investor in mutual funds?
Yeah, right. I'm the first-time investor, so that's why seeing the SIP or the AMC currently, I see there is a lot of increase in the SIP market. So basically, I just want to know what are the best one to invest for 2023, taking both in the direct and the debt one also.
All right, interesting question. And Kaustubh, today by default, I don't know why we are just getting queries of all first-time investors on the show. And this is very interesting also because currently the kind of SIP stoppage ratio that we've seen, it's come on a 27-month high. So, there is this data on one side, and then we have the callers on our show which are showing interest and confidence also when it comes to investing in equity market, and this is via SIP. So that's a very interesting trend on this show for us also. But answering Siddhartha's question, he's a first-time investor and he wants to know about investing through a direct mutual fund. How should he go about it?
So I think, Kavita, the good part is, like you said, that people are thinking SIP, so people are thinking about regularly investing rather than it being a one-time activity, so which is great. And I hope this trend continues to kind of build. And we're excited to have investors such as Siddhartha, join us on the show. So the first thing I think, Siddhartha, you need to really think about is, are you in a position to take some of these, understand your own personal financial aspirations and your own portfolio by yourself. If that's not the case, I would sincerely advise that you should reach out to a professional advisor or a distributor who can help you structure a portfolio, which is in line with the needs that you have, right? And we spoke about earlier in the show that every investor needs to go down to the drawing board and think about what are his or her ambitions with the money that they're trying to, because when you're saving and investing the money, it is with an end need or a goal in mind. So the first thing you need to do, rather than thinking funds, is think about what are my goals, which will derive two things. One is, what is the time frame that you're looking at, because goals can be varied, right? So goals can be 1 year down the line, could be 5 years down the line, could be 20 years down the line, right? So that will form your pool of goals, the money that you need at different points of time, which will kind of derive that what is your risk-taking ability, right? We spoke about the ability because that will, and then finally, decide upon the asset allocation, which could be, it's a very unique thing to every investor, right? Once you've derived this, and like I said, if that's something you feel you can't do on your own, I would definitely recommend going to an advisor to help you with this, right? Once the asset allocation is dividing, then we come down to fund selection. And typically for fund selection, to your question, which are the best funds to buy in 2023, I would say diversified equity funds, if you have a long-term horizon, are probably the best tool to make money over the long term, to invest over the long term. Obviously, if you have shorter term needs and goals, then we have a great array of fixed income mutual funds that are available, all the way from just short term parking for a week, going all the way till 3+ years in terms of fixed income investing, across categories. So I think it's very, very specific on the individual. But like I said, some ground rules. First, figure out your goals, which drive your asset allocation and your investing time horizon. When we talk about time horizon, if you think about equities as a asset class, minimum 5 years, ideally at least 10 years for volatile sort of fund categories like mid and small caps. When you're picking funds, another very important ground rule: do not just simply go by picking funds that have done well recently, even within the categories that you want to invest into. Because I think two mistakes that investors end up making: one is picking funds that have done well from sectoral funds. I think the earlier conversation was very interesting, Kavita, where because a sector has done well in the recent past doesn't mean that it's going to continue to do well in the near future. Right. So I think that's some things that you need to keep in mind, and build a good diversified portfolio of funds, rather than just sticking to the best funds that I want to pick within funds that meet your goals, rather than which are the best funds, because this one fund which is good for one investor may not be the case for another investor.
Exactly. So a bit of goal planning, Siddhartha, and then give us more information, and then we'll give you the right and most suitable advice for you. On that note, thank you so much, Kaustav, for being on the show and helping our viewers with their financial portfolio today. And before I sign off, I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your questions. Do send us your financial portfolio queries, and we will get them answered by our experts. Thank you so much for watching. Goodbye.